Welcome to the Kim and Jerry podcast, your source for all things mortgage notes and passive real estate strategies. Whether you're considering mortgage notes as a business model or exploring passive real estate opportunities, we've got you covered. Unlocking the secrets of financial success, one mortgage note at a time. With expert insights, pro tips, and engaging conversations.
Hi, Jerry.
Hi, Kim. How are you today?
I'm well, thank you. Good to see you. I'm very
Good to see you.
excited about today's show. Before we get started, though, I just want to give our disclaimer, which is that we are not attorneys or CPAs or financial planners, but we are mortgage note investors, and we are excited to share, as always, what we do. And this today is a little bit different than what we normally do, Jerry.
Yeah,
We have company. I'm
yeah,
excited to have our viewers meet one of our B2B relationships that we have. We've been working with their investors who have been interested in investing in notes, and just wanted to make sure that everyone had an opportunity to know, um, I guess, how this relationship works, right? With self-directed IRAs and notes being able to invest, it's very powerful. And I don't want to give away anything, but I think that this will be a good time for everyone to at least see and explore the options of investing through their self-directed IRA. Um, I know, Jerry, you have also looked into this. I
yeah.
know that you have also shared with us, right, how we can do this as a team, as a company. You wanted to, before I
Yeah.
introduce them, would you want to share with your experience?
Sure. One of the things that we also want to say is that we want, part of our podcasts and our webinars and so forth is to provide education to our listeners, to our viewers. So one of the things that we hope that people get out of this is a little bit more knowledge about things that they can do for wealth protection, wealth growth, and so on. For me, I set up a solo 401k, I don't know, 6, 7 years ago. And it was a profound shift in going from having all of my money managed by others and funds and whatever, and to be able to actually direct where I wanted my monies to go.
Right.
And hopefully, at the end of um, this episode, folks will have a chance to see, hey, they can do the same thing for themselves.
Yeah, because, up until I'm not even sure, it's been a couple of years, I didn't even know it was an option, right?
Yeah,
And so now it just seems, all par for the course, right? So
absolutely.
let's not delay any further. I would like to introduce Rachel Stolrow from the Entrust Group. We have become great friends, and I always enjoy her insight and, of course, her direction. And you've been so very helpful for us. Rachel?
Oh, thank you very much, both of you, Kim and Jerry, for having us on here today. I'm so honored that, to share a little bit about, like you said, diversifying your portfolio and about what different investment options may be held within a retirement plan. Before I get into it, I have a disclaimer as well. So the Entrust Group, or AKA Entrust, we don't provide investment advice or endorse any product. So all information on the webinar today or on the podcast today will be for informational purposes and educational purposes only. We always encourage clients to please consult an attorney, an accountant, an advisor before entering into any investment decision, especially if it's one that they may be unfamiliar with. So throughout the podcast today, we're going to go over introducing self-directed IRAs, some of the benefits, investment options, who a disqualified person may be, options in terms of funding, frequently asked questions, and then, of course, Kim, Jerry, like, we had mentioned, please feel free to interject and ask any questions along the way. I'm happy to just be here and answer those questions. So before we dive into the meat of what we have here today, there's a little bit about me. So again, my name's Rachel Stolrow. I've been with the Entrust Group for 7 years, so for quite some time. And my role here as a business development manager is to educate clients, investors, professionals, companies, etc., on how to invest in alternatives, which we'll get into within a retirement plan. So Entrust, we have been doing this for quite some time. We are a self-directed IRA administrator. We have very knowledgeable staff, many who hold the CISP, which is the Certified IRA Service Professional certification. And we are huge on education, just like I know you, Kim and Jerry are. We love to do webinars, podcasts, you name it, and just really educate on investing within a retirement plan. So we have over $5 billion in assets under administration. We have over 24,000 active investors. We've been in business for over 40 years. I want to say it's around 45 now at this point. And we're really big on a single point of contact. So what that is every single company and client gets their own dedicated team of 2 here at the Entrust Group. It makes it really unique because even though it's a great fun space to be able to make all your investment decisions, it can also be a little bit complicated, especially when you're not used to self-directed investing or investing in alternatives. There's a lot more paperwork involved. So really having a dedicated team of 2 helps streamline the process. It puts clients at ease because we're able to talk about any questions that they may have. And so that's one of the biggest things is we really love to provide a dedicated team so that clients and companies feel well supported. All right, so diving into it, what is a self-directed IRA? A self-directed IRA is just like any other retirement plan. It just allows for individuals to take charge of their investment decisions. There's a greater opportunity for asset diversification outside of traditional stocks, bonds, and mutual funds. So most clients are used to their retirement plans being held at a large bank or a brokerage firm that limits them into investing in the public market. Usually that's stocks, bonds, mutual funds. But the IRS says, actually, you can invest in so much more beyond the public market. And it can be, we'll get into it, but anything from real estate, mortgage notes, technology, you name it, to precious metals. And so there's so much greater opportunity, but clients don't notice that or realize they can do that because the custodian that they're with puts limitations onto what their plan can invest in. So a self-directed retirement plan at its core is another retirement plan. It's the same thing, same tax benefits, but the clients in the driver's seat making a decision into where they want to invest. All securities and investments are held at a retirement account like Entrust that's administered by a regulated trustee or custodian. And that's what we are. We are a trustee and a custodian that administers retirement plans. Like a lot of clients will say, well, since I'm self-directing it, can't I just take the money out myself and now I can direct it where I want to go? And the answer is no, right? You need a regulated custodian to be able to do the record keeping, the reporting, and keeping these investments in a tax sheltered account and following the IRS rules. So defining key roles within a self-directed plan. Number 1 is the IRA holder, which is an IRA is an individual retirement account, right? So it's the individual person. Then you have what we just went over, the custodian, which would be the Entrust Group in our case. And then you have the actual plan that's making the investments. And that's what the custodian is record keeping for, right? They're making those investments. And this is essentially where the alternative investments are held, is within that individual retirement account. process works. So I like to say, hold on, we have about 4 steps here. There's about 3 to 4 easy steps. And I say easy with a smile because it's something that, I do on a day-to-day basis, which again is why it's so important that we provide that dedicated team of 2, because it really allows the process to flow a lot more quickly. So how the process works, investing in a self-directed plan, is number 1, finding that right custodian, seeing who you want to partner your IRA with. How long have they been in business? How long have they been doing this? What does their client services look like? Who's going to be that other person on the end of the line when you are going through the self-directed retirement process? So finding that custodian, choosing your account type when you open your account, and choosing would be more in the terms of making sure you open the right one in terms of what you already have at this most likely bank or brokerage firm, right? We need to open up the same type of retirement plan that you may have in terms of contribution type. Is it pre-tax or is it a post-tax account, so that we don't commingle those funds and you can transfer it over with ease. Funding your retirement plan through that current retirement plan that you already have, or via a contribution, which happens, but it's not quite as common. And then directing your custodian, again, in this case, the Entrust Group, to purchase assets on behalf of your IRA. So this is where you really get to ultimately make those decisions and say, hey, I have this mortgage note investment in trust. How do I get this funded? This is where I really want to put my money. Or precious metals investment, how does that process work, right? So then now you, the client, are directing us to where to put these funds. So with any investment, right, comes benefits and risks in terms of alternative investments. So let's get into some of the ones when it comes to private market investments. So some of the benefits are huge. It's portfolio diversification. Clients get to invest in either companies they know, like, and trust, where their knowledge lies, right? Maybe it's a realtor who's investing in real estate and they're really familiar with certain markets. So it really is designed for portfolio diversification and clients taking that seat in the driver's seat and investing in things they know, like, and trust. There's tax savings, right, or benefits, whether that's pre or post tax, they have different benefits. And then it gives that client the control. So instead of investing in stocks in a public company that, who knows how that's going to go, or maybe they don't even know what company they're investing in, they get to, again, take that control and invest in things that they already know, like, and trust. Again, investing in what you know best. So there's so many investments available within a self-directed plan. It's really great to invest in what you know best and capitalize on your expertise. So again, tons of realtors are investing in different real estate that's local to them and they know the market, storage units, etc. Mortgage notes, the list goes on and on. Contributions, they save on taxes by reducing your taxable income. So again, based on the type of plan you may have, again, you may be able to reduce your taxable income. There's 2 different types, and we kind of talked about this before. Is it pre-tax or post-tax? So if it's pre-taxed, meaning the tax is deferred, meaning your investments grow tax deferred and you don't pay taxes on that money until you pull it out personally, right? You're looking to take possession of that investment personally, or you're looking to now have a cash withdrawal personally, is when taxes would be due. A tax-free isn't necessarily free, meaning you're paying the taxes up front. It's a Roth plan. You've already paid the taxes. So no matter if the taxes are more or less, when you decide to withdraw those funds, you will not be paying taxes when you decide to take possession of either your investment or the cash in your account, right? Because you can ultimately take out an investment if you wanted to change that to you as the investor as well. And we see this most commonly with real estate clients. Maybe they don't want to sell it. They want it for the purpose of retiring within this home, but instead of selling it, they'll take a in-kind, is what it's called, distribution, where they're now taking this personal possession of this property. We kind of went into this, so tax deferred versus tax preferred. Again, that deferred is what's called a traditional IRA. You invest your pre-tax income, allowing you to defer those taxes when you withdraw. And then tax deferred earnings, again with Roth, you invest with already taxed income, which allows your investments to grow completely tax-free. So some of the risks to consider when investing in alternatives, it's not quite as easy to trade or sell a stock, right? There's a big lack of liquidity when it comes to alternative investing. So when clients invest in alternatives, it's really common to see certain hold periods or not being able to liquidate your investment or be paid on your investment for sometimes 5 or more years, depending on what you're invested in. So one thing to consider is there's a potential lack of liquidity in investments. There's an increased responsibility. So we already talked about banks and brokerage firms and what they do and don't allow, but a lot of banks and brokerage firms, what they do is due diligence for clients. And we're going to get into this a little bit more later, but they do due diligence. They act as a fiduciary, right? When it comes to a self-directed retirement plan, there is no fiduciary. We're not licensed to be a fiduciary. There's no fiduciary responsibility. That responsibility is the burden of the client. So there's an increased responsibility when it comes to making investments, making sure investments are vetted. And again, really investing in what you know, like, and trust, because that client and or their financial advisor or professional should work on this together, because there is that greater responsibility that lies on them. There's a greater potential for fraud. So if clients aren't looking into their investments, if they're not, if it's maybe a new company they've never heard of, right? If they're not doing their own due diligence, there is a greater potential for clients to fall into sending their money to the wrong place or investing in an investment that doesn't come to fruition. And then complicated fees for some custodians. We have a pretty easy fee schedule and clients are always able to reach out to me, but some fee schedules when it comes to different custodians that they're working with can be really complicated in terms of, okay, what am I really paying at the end of the year and how does this work out? So these are some of the things to consider when investing in alternatives. There are also investment restrictions and options available. So again, we went over this, and some of this we'll go over a couple of times because I want to add on to it, but there's so many types of investments allowed. And this is another question that I get is, what can I invest in? And I always say a better question is, what can you not invest in? And there's really only 3 things that cannot be held in a retirement plan. So just to go over some of the things that are allowed, it's anywhere from mortgage notes to multifamily units. Maybe it's an Airbnb, precious metals, technology, startup companies, loaning money to a friend or family member that isn't a disqualified person. The list truly goes on and on and on into what you can invest in. LLCs, clients can have LLCs where they can make those real estate investments and have an Airbnb or long-term rental properties. Cryptocurrency is a pretty big one, or was a pretty big one. Again, apartments, condos, commercial property, etc. So the 3 restricted investments are collectibles, which is a little different than precious metals of a certain grade, right? Like gold, silver can be held in a retirement plan. But if you're looking to have a stack of, baseball cards or certain coins that aren't of a certain grade, or maybe cars, those would all be collectibles, right? Cannot be held in a retirement plan. Life insurance policies cannot be held, or S corporations. So quite literally any other investment type outside of these 3 things can be held within a retirement plan. So again, the possibilities are really endless. what you can hold in your retirement plan. And another question I get is, do I need a new plan for every single investment? And you don't, right? You can have one traditional IRA or one Roth IRA plan and have mortgage notes in there and have gold and silver in there, and also, maybe some other form of real estate. We went over this a little bit, but collectibles would include, certain grades of metals or gems, stamp or coin collections, alcoholic beverages, works of arts, and the exception would be gold, silver, platinum, bullions of certain purities. So beyond the 3 things that you cannot invest in, right? One thing you'll want to keep in mind is prohibited transactions and persons. Essentially, you cannot do business with yourself or something that you already own outside of your retirement account. And so who would be a disqualified person? A good way to think about it is yourself and anyone in your direct lineage, which would be your spouse, your mom, dad, grandma, grandpa, great-grandparents, or anyone below you, like children, great-grandchildren, great-great-grandchildren, fiduciaries, plan service providers, etc. Right? So anyone in your direct lineage, or maybe your fiduciary, or actually a beneficiary on your retirement plan. Any qualified person is anyone else. So brother, aunt, uncle, those are all qualified people to either lend money to or make an investment with, purchase an investment from. Prohibited transactions. So what that is it's improper use of the IRA plan, the plan participant, or a disqualified person that is not permitted by the IRS. Some clients like to try to get a little fancy, right, to get around the rules and purchase something that they shouldn't be purchasing. But the rules are the rules, right? And really to not be engaging in an investment that's already held in any of those disqualified persons that we talked about, because it could put the entire retirement plan at risk. So a couple of concrete examples of what a prohibited transaction would be: borrowing money from a disqualified person, selling property to a disqualified person. So trying to put that home that you already own into a retirement plan, or, an investment that you already own because maybe it's going to go really well. Now trying to purchase that from yourself and funnel it into a retirement plan, those are all disqualified. You cannot do that. And then using your IRA plan as a security for a loan. We already talked about this, but yeah, using that IRA for personal use. So even if it's a property that you already own, you can't even use it if it's something that's owned, and we'll get into this a little bit later, by you and your retirement plan, because even though you're a disqualified person, you can form a new partnership if an investment has not been made. However, that does not mean that you can go and stay in a property, right? If you have a really cool property in Mexico that's in your retirement plan that you use for rentals, you can't go vacation in it in the summer. So accepted transaction. So a couple of things that are acceptable. Again, that's partnering with yourself on a brand new deal. Maybe you don't have 100% of the funds within your retirement plan to purchase the note or lend the money that you want to lend, or purchase the home that you want to purchase. But hey, you and your spouse do, or your retirement plan and you as an individual do. Well, you can go in and partner on that brand new deal as long as nothing's been done. Your cousin, your spouse, again, which would typically be a prohibited person, you can go ahead and partner with that on a brand new deal, leasing the property with siblings, etc. So things to think of when it comes to investment due diligence, and I'm just going to put this here. Again, the burden is on the client. So please do your own due diligence. Look at companies, properties, whatever that may be that you're investing in. Get expert advice if it's not something that you're familiar with. Investigate, the background of companies, their principles, getting copies of written materials, quick research, or research what the risks are, and how you may want to liquidate. So we talked about how it's investments are typically pretty locked in or illiquid for a certain period of time, but what are those, rules, and how long are things illiquid with the company that you're looking to invest in? Review any investment documents before you sign them. And it sounds really, funny. And I laugh because you would think, yes, that's something we're all going to do. But I've fallen, to just getting things signed, even when it comes to, purchasing my own home, just making sure that I get documents signed and I don't really read everything. And so really just having clients take a step back, review, read what you're investing in, consult with that financial advisor, attorney, legal advisor, you name it, if this is something that you are questioning or need just help with understanding. In terms of kind of going back to, you're looking to invest in an alternative, you want to open up this self-directed retirement plan. What are the funding options? So how can I fund this retirement plan, and how does that work? So typically after you find a custodian that you want to go through with, have hold these alternatives, it boils down to funding your retirement plan. And so the three ways to fund your plan is, number one, via a rollover from an employer sponsored plan. Maybe that's a past employer, maybe that's a current employer, if the plan allows it. Transferring over money from another individual retirement account, or making a contribution. Contributions aren't quite as popular because contribution limits are pretty low in terms of IRAs. Where you'll see a higher contribution limit is, as Jerry mentioned, maybe you have a solo 401k or a SEP retirement plan. And you are self-employed, and now you have a retirement plan for your business. The contribution limits will be much higher. So typically it's a rollover or a transfer, bringing in funds from another custodian. Oh, and then going back to this, you don't need to roll over your entire plan. Clients will ask that a lot. I only want to invest a certain portion. Do I need to sell everything in my plan, or do I need to roll over my entire plan? And the answer is you don't. You can transfer over money as many times as you like. So if you decide later in the future you want to do something else, you can do that, but you do not need to bring over your entire plan and close that out just to have a self-directed IRA. So a rollover is when funds are coming, like we mentioned, an employer sponsored plan. Sometimes that's a 401k, a 403b, a pension plan. Those would all be a rollover. And then a transfer is an identical account. So we hold primarily individual retirement accounts. If it's coming from another IRA, usually that's a transfer. It's a non-reportable transaction, with those funds coming to an Entrust retirement plan. And then again, contribution. So as you can see here, contribution limits for 2024, about $6,000. So if you have a sizable investment, it could take quite some years to get that contribution, that annual contribution to total the amount of your investment. So diving into our frequently asked questions when opening up a self-directed retirement plan. Number one, mortgage notes are pretty popular. So how does that work within an IRA? And as we already discussed, is doing your due diligence. Look at a custodian that you want to work with. Choosing your account type in terms of, what plan do I already have at my current retirement bank or brokerage firm? Do I have a pre-tax or a post-tax? Making sure your account gets funded. Finding the company or entity that you want to conduct business with and lend money to. Doing any due diligence and submitting your investment request to the Entrust Group. And then typically it takes about 3 to 5 business days for us to ultimately review your investment documents and get those funds into the hands of your investment that you have chosen. What happens to income and expenses in the retirement plan? So just the same way money goes out of the IRA, money will come back into the IRA. So when you sell in an investment, or maybe you're getting monthly payments back to your IRA. All of those funds would go back into your retirement plan. Yes, if you want to reinvest it, you can do that. If you want to make a new investment, you can do that. If maybe you want to put those payments back to your bank or brokerage firm so that you can invest in the public market as well, you can do that, right? But as long as money flows back into the IRA the same way that it came out, so that we can do proper reporting. And remember, you cannot use personal funds to pay for any expenses occurred. Where we see this incurred a lot is going back to real estate, right? Clients think that maybe they can pick and choose, and hey, this really low payment of $150 for landscaping came up, I'm just going to pay it personally. You can't do that. Any investment that's held in your retirement plan needs to come from your retirement plan. And if it was purchased via a partnership with the retirement plan, it needs to be split for the partnership, both income and expenses. We've already talked about this, and it's a question that we get all the time. Can my IRA partner with others to invest? Yes, it can partner with anybody that you want, as long as it's at the initiation of the investment. And then once the transaction is closed, that is it. So you can't say, hey, can my wife come and partner with me on this property, or, this money that I lent last year, right? It would need to be a brand new purchase from there. And so wrapping up here, we're always an open book. We love to answer any questions that come up. Like I said, we are huge, huge, huge on education, answering questions, providing a dedicated team. My contact information is up. You are welcome to reach out at any time. I'm happy to assist. And then Kim, Jerry, please let me know. I know we covered quite a bit in terms of how a retirement plan works, so please ask any questions.
I have a quick one for you. We talk a lot about the IRAs, and you mentioned briefly the Roth, and you mentioned briefly the 401ks. Can Entrust also do those types of accounts?
Yeah, absolutely. So we have Roth, traditional SEP IRA plans, and we also do solo 401ks.
Okay.
Yep.
Cool. Yeah,
Yep.
that's and I think going way back, that's why we set up ours as a 401k, because it was a contribution from our company.
Yeah.
We set up for our retirement plan. So
Yeah. So we work with companies all the time on that, or even simple IRA plans where, a small business may want to set up some plans for their employees. We do all of that as well.
Another question that came in, that just sort of popped in my head: what about taxes? When funds are withdrawn, how do the taxes get covered?
Yep. So when you complete, or when a client says, hey, I want to take a distribution of X amount of dollars, on that form, it asks the client if they want taxes taken out of the contribution, right? So, and then either way, we will report it at the end of the year to the IRS that X amount of dollars has left the retirement plan. So it's also good to note with your tax advisor, whoever you're working with, to do your end of the year taxes about that. But we will report it.
Great, that's good. I saw in one of your slides, it was in the due diligence, it was about return policy. What is a return policy?
That is a great question. So sometimes if you maybe want to back out of an investment, and this is really rare and something that's completely outside of the Entrust Group, right? And between the client and the company specifically, but maybe is there a period in which they can back out of an investment and say, hey, can we reverse that?
Got it. Yeah, when I saw that, I was thinking of going to Walmart or Home Depot.
Totally. Yeah. Oh, it's so funny. The first time I read it, I did too. I was like, it's an interesting way to put it. But yeah, if there's some sort of back out period.
Wow. Well, this has been great. I'm a big proponent of the self-directed tax accounts, and I think that it's a great way for people to take control of their money.
Yep.
And we've been using it, like I said, for years now, and it's been a tremendous success for us. And it's really helped us, and we've gotten a much better return because we were able to invest in alternatives that weren't
Yeah.
available in the regular market.
Yeah, exactly. Or at least diversify, right? Because the market is always so up and down. And so, okay, yeah, maybe you are quote unquote diversified. You have real estate stocks and stuff, but are you really diversified in terms of, having alternatives within a different type of plan? So clients don't realize they can do it, and it provides them, like you said, sometimes a lot better of a return.
Absolutely.
Yep.
Absolutely.
Yep.
Kim, I've been dominating the question and answer. I know you're sitting there.
It's unusual because I'm the one that normally dominates. I let Jerry talk for like
So
5 minutes,
it's your
and
turn
then I
this
take
time.
over. But I do want to add that this was great because I think it does spell out exactly how you can leverage your investments, and also have control over your portfolio and diversify. And alternative assets are now on the rise. Everybody's looking for other ways to invest outside of the stock market. And, everybody's getting a little nervous, of course, and all that kind of stuff. And so having, this type of vehicle to be able to invest in alternatives kind of puts things on the ease and thought of having control, also knowing that your investment is safe, if you will, when using a self-directed IRA, right? It's not widely known that this is
Yeah.
something that
Yeah.
can be done. Every day, I'm of course, I share with what you have shared with me, Rachel, of course, and how the complementary relationship between notes and the self-directed IRA can work and be effective. And we've had, positive experiences with the Entrust Group with our investors who have gone that route.
Yep.
And we've had repeated investors who just go back and do it again, of
Oh,
course.
yeah.
Yeah,
Yeah. Especially
because they
because
see.
when it comes to lending money or making an investment, you don't always have that money also, within your normal savings account, because most people, if they're saving, they're usually saving towards retirement, AKA in a retirement plan, and they don't realize they can actually tap into these funds and use those to make that purchase. So, like you said, just even that education into, hey, this is something that you can do. And even though we've been in business for 40 plus years,
Yeah.
I hear the same thing. I had no idea you could do this. And
Right, right.
yeah,
And
it's very,
but
very possible.
so yeah, and I thank you again for sharing your time and your slides with us and this
Of
information
course.
for us, because now we have a point of reference that we can do this with our investors to be able to go back and revisit and answer a lot of the questions that we are really, at least I don't feel equipped to answer. But I do always steer them in this direction, if you will. But and like I said, because alternative assets investing is on the rise now, it's very popular. We want people to know that this is a viable and very effective way to invest.
Yep, yep, and very possible, right? It's
Yeah.
very possible to do it
Yeah,
within your
yeah.
plan. Yep.
This was great.
Thank you.
Again, it was very thorough too, and I loved the layout. I loved how you
Oh, thank
walked
you.
us through. No, this is great. Because people can then wrap their mind around how this works, and of course,
Yep.
for us, it's just contractual. We just see as
Yeah.
answer the questions, and
Exactly, yeah.
we make this work with you guys, and so this is perfect. This is perfect.
Yes. Yes.
I don't have anything more though, not yet. Maybe we could have another session in the
Questions?
future.
Yeah.
Yeah.
Would love, yeah.
Yep.
We get a lot of feedback afterwards, so maybe there might be opportunity to be able to address their questions directly and have another talk on this, about a session where we can come together have something more direct for them to follow.
Yep,
I
that would
do
be
have-
a lot of fun.
I do have one more question.
Yes.
So as Kim said, it's not uncommon for us to get questions, calls, and so on. If we do get a question, is it okay if we send them to you?
Absolutely. Yes.
Okay.
Yeah, absolutely. We're always happy to answer questions here when I talk to companies, and I want you to know too, hey, you don't have to be the expert in the self-directed retirement space. There's enough that you need to be an expert on, I'm sure, in your own business. And yeah, don't worry about it here on this side. Feel free to just send them my way. The number, it's funny, my number listed here is a little off. It's actually 949-335-6391. So, Jerry, yeah, feel free, email, phone number, whatever works best for you. I'm always happy to help.
Fantastic. We'll do that.
Okay.
Yeah.
Well, thank you both for having me on. It's been such a pleasure. And hopefully, we get some good questions, and I look forward to doing this again with you in the future.
Thank you, Rachel. My
Thanks,
pleasure.
Rachel.
Thank you.
We really appreciate it. Thanks.
Of course. Thank you. Take care.
Take
Bye-bye.
care. Bye-bye.
And that wraps up another episode of the Kim and Jerry podcast, brought to you by First Shield Financial, your trusted partner in cash flow investing. If you found value in today's discussion on mortgage note and passive real estate strategies, don't forget to hit that subscribe button, connect with the Shield, and stay in the loop for our upcoming opportunities and episodes packed with even more insights and inspiration.